Hello and welcome to Mutual Fund Corner, and on the show today we'll be discussing two very important aspects in mutual fund investing that investors should be aware of. First is swing pricing and the basics that we'll discuss with Joydeep Sen, corporate trainer and author. And in the next conversation, we'll try and understand with Nirav Karkera of Fisdom how to analyze the cash position in mutual funds. Is this an important metric that investors need to understand or not? So let's get started with the first topic, that is swing pricing. Now, the Securities and Exchange Board of India, SEBI, wants to protect small investors who put their money, often significant chunks of their retirement corpus, into debt mutual funds. As a part of this endeavor, the capital markets regulator has introduced a swing pricing mechanism in open-ended debt mutual funds. Swing pricing is a mechanism by which redemption costs are apportioned among those unit holders whose trades impacted the NAV. The mechanism is designed in such a way that the remaining unit holders don't have to bear all the costs of the redemptions made by a select few. In a situation where there is a liquidity crunch, the swing mechanism effectively ensures that those redeeming their monies are charged for the redemptions, thereby seeking to dissuade them from doing so. Often due to low liquidity, fund houses have to sell their investments to meet redemption demand. This leads to a fall in the NAV of the fund. So no better than Joydeep joining us today. Joydeep Sen is the corporate trainer and author, joining us today to explain this complicated topic in a simpler manner. Joydeep, thank you so much for joining us today. Always a pleasure speaking with you. So first up, if what I said about swing pricing, how do you put that in an illustration so that it's very easy for our viewers to understand that as well? What does this exactly do?
Sure. Just to recall a known concept, that of exit load. Exit load is defined, like if a fund says 1% for 1 year, it is defined for that period of 1 year. Now coming to swing pricing, there are certain terms or conditions when that swing pricing comes into play or it does not come into play. Like you said, full swing and partial swing. So full swing is a market-wide situation which is triggered by SEBI. It could be a market-wide aberration, dislocation, or a liquidity crunch kind of thing, which you referred to. And a partial swing is a kind of specific to a particular AMC or a particular fund. They may be facing a run on the fund and that kind of thing. Now coming to the question as to illustration, because that will help explain the concept for viewers and how does this work. There's a fund, let's say a credit risk fund with a corpus size of rupees 1,000 crore and an NAV of rupees 15 as an example. And let's say the terms mention that this fund can trigger or will trigger partial swing. And the definition of partial swing is redemption of 10% of the fund. And that extent of swing, partial swing, is 0.5% of NAV. So how would it work? If it so happens on a fine morning or not so fine morning, the fund faces a redemption of rupees 110 crore. So just to recall, fund size 1,000 crore, 110 crore, more than 10% of the corpus size. So that redemption happens and that partial swing is triggered. And the partial swing is 0.5% of the NAV, which means those who are exiting, they will get an NAV of rupees 15 minus 0.5%. 14.92 is the NAV they will receive. So what's happening here is, out of that 110 crore rupees which is being redeemed, rupees 55 lakh, which is that, that 0.08 into that number of units, rupees 55 lakh is being taken from the exiting investors, and it goes to the fund, which means it goes to the existing or remaining investors. So it's a kind of equity or fairness. Those who are like fair weather, those who are exiting, they are giving it back to the fund. Now coming to full swing, as an example, let us say there's a market-wide dislocation and SEBI triggers full swing of say 1%. So 1% of 15 rupees is like 15 paisa. So those who exit, they get 15 minus 1%, which is 14.85 rupees. So 1.1 crore is the quantum which will be deducted from the exiting investors, and it goes back to the fund as an equity or a fairness to the existing or remaining investors. So that's how broadly it works.
Okay, all right. So that was a very helpful example as well, Joydeep. So this basically is done in order to ensure that the remaining investors do not get impacted by the fall in NAV. And it usually happens when there is 10% or more redemption at the time, or there's a different limit for different cases.
Okay, two things here. Like you said, different limits for different cases. There is something called partial swing, which is kind of not compulsory for the AMCs. There is an AMFI guideline. If AMCs want, they can implement it, and they have to have it in the SID. Not like, they feel like doing it. No, not like that. They have to have it in the SID. So whatever terms are there in the SID, if that is triggered, the AMC triggers that. But these terms can vary from AMC to AMC. And what you refer to as fall in the NAV, I would put it slightly differently. Not exactly a fall in the NAV, but it's like, Just to recall what happened in March, April 2020, one AMC shut down certain funds due to a liquidity crunch. Those who exited earlier, let's say sometime in March or April, the AMC sold papers which they could sell. Let's say, as an example, AAA. Those who remained, they remained with a portfolio which is like AA or single A, which is not as good as when it was when the redemptions started. So it is like those who are exiting, they're kind of taking the cream with them. Those who are remaining, they have a relatively inferior portfolio. So that is the fairness I'm talking about. NAV swing can happen any which day. It's like the portfolio quality which remains with the existing investors.
Okay, all right. So I take that point. It's partial versus full swing is different, and it also depends from AMC. And the example that you gave of what happened during COVID is very important as well. So that means it's good for the existing investors. They are paid for being there with the fund at that particular time. But are there any limitations of swing pricing as well? Something that it does not consider and is something which could be negative?
I won't say negative per se, but limitations are there. One limitation is, like I'm saying, this equity or fairness. How do you measure or how do you quantify? Whatever number we discuss, like 0.5% or like 1% we mentioned, if it is like 0.5%, it is only an estimate or guesstimate as to what could be the impact. As an example, fair weather investors are exiting, those who are remaining, that may lead to a fire sale. It's difficult to quantify a fire sale. And secondly, as I mentioned earlier, partial swing is kind of not compulsory with AMCs, and the terms may vary. Somebody may say 0.5%, somebody may say 0.2 or 0.3%. Of course, depending on the AMFI guideline, the AMFI is defined as per that PRC framework. Some AMC may not even have it. So these two are the kind of limitations of this concept of swing pricing.
Okay, all right. So just limitations. There's nothing really negative about swing pricing as a concept here. Now we spoke about how it helps the remaining investors as well. What are the other ways when swing pricing helps investors? And do we see that happen a lot, like in debt mutual funds? I just want to understand, because COVID-like events do not happen so often. But when they do, is this something which helps the investors completely?
So on the frequency of happening, I would say ideally it should never happen. Okay, it has happened earlier. Like to recall, July 13, 11 years ago, market was tight. March, April 20, there was liquidity pressure. But why I'm saying ideally it should never happen, now there is a mechanism in place. There is a fund of 30,000 crore in the AIF format given to a particular large house, a leading house of India. What that fund will do is, in case of a liquidity crunch or a redemption pressure in industry-wide, they will buy these not-so-liquid papers from the mutual fund industry, and mutual funds are contributing to the corpus. What it means is there is better stability than earlier, and hopefully, ideally, we should never have to resort to that kind of situation. To the other question as to how it helps, so as and when, if in case it leads to fire sales, that compensation they have already received from the investors who exited earlier.
Okay, all right, get that point. So last question before we let go of this interesting and very useful discussion, Joydeep. Is it largely for debt funds only in India and everywhere? Does it help equity funds at all? Or you think this is something that just suits debt funds for now?
So conceptually and currently, as per regulations, it is for debt funds only. But since you raised this interesting topic, we can debate this. Equity, so equity, we have large cap funds, we have small cap funds. Large cap funds have enough and more liquidity. But in small cap funds, depending on how small the particular fund is, how liquid the counter is. So small cap definition, as you know, as per SEBI, is 251 and onwards. If the cap is like 100 or 2000 or 4000, whatever, depending on the size of the small cap stock and the liquidity of the particular small cap fund, we can debate this. There may be a case for small cap funds also, in case there's a redemption run on a particular small cap fund. Those who are remaining, they may be left with illiquid stocks in the portfolio, which is conceptually similar to the debt fund swing pricing.
Okay, all right. So right now with debt funds only, but as you said, it's a debate and we'll have a longer discussion on this someday, Joydeep. But thank you so much for joining us today and explaining that tricky concept to us, and hope it helps the viewers as well. With that, we'll take your leave on this show right now. But we'll do one thing, we'll take a quick break, and on the other side, we'll talk about cash holding in mutual funds, analyze that portion with Nirav Karkera of Fisdom. Stay tuned for that conversation. Welcome back. You're still tuned into MF Corner, where we spoke about swing pricing in depth and try to understand what this concept is really about. Let's talk about another important and interesting topic. Let's welcome Nirav Karkera, the head of research at Fisdom, and let's try and understand and analyze what does the cash part of a portfolio means when it comes to mutual funds. Nirav, good afternoon. Always a pleasure speaking with you. Thank you so much for joining us today. Well, usually when we look at mutual funds, we talk about what is the equity portion, what are the stocks a fund holds, or maybe if it's a debt mutual funds, what are the constituents there? But is it very important to analyze the cash component of mutual funds? And if yes, how does one do that?
So hi Sonal, this is a really interesting topic to talk about, because often when we talk about funds, we'll end up talking about equities and debt and allocations within it. However, little do we realize that cash as an allocation is also a very critical element that one needs to assess while evaluating a mutual fund. So yes, definitely right at the outside, definitely it is important to consider cash allocation while evaluating a mutual fund. In fact, what's more important than assessing the quantum of cash that has been allocated, it is important to understand the reason and the context why such allocations were made towards cash. There are two primary reasons why cash allocations are made largely. Number one, to manage fund flows, to manage redemptions, etc. You keep a certain small percentage in buffer as cash, so that you don't come under a lot of pressure to liquidate investments each and every time. There are redemption requests that are supposed to be serviced. So this is the straightforward, the simple reason for why cash allocation is made. The second one is something that most people don't seem to acknowledge or appreciate as much, is that cash allocation is also an active fund management call. So especially in terms of equity funds, right? A cash allocation could be a very active way of holding on to dry gunpowder and waiting to deploy those funds if, as a fund manager, you believe that certain opportunities are going to be available at a better price point. So that's one. Second, cash is also an effective hedge against extreme volatility within the space you're operating in. Let's talk about certain funds, if who typically operate in a very narrow universe, like a sectoral or a thematic fund. If the sector or the theme itself is undergoing a rough patch, a fund manager may effectively hedge his exposure. In fact, it's not quite a hedge; it is defending his exposure to such long positions by holding on to a larger proportion of cash. So this way, there is lesser percentage of the portfolio that is exposed to the rough patch, and this in fact helps the investor makes more in terms of real returns by way of protecting the investors from the downside. So the context is very important. Cash in this situation, as you would realize, it could be an asset or a liability depending on how you use it. If you use it well, if you allocate to cash to defend against rough patches, if you use it to wait out for a better opportunity, it is an asset. However, if you sit on excessive cash while opportunities are available and you do not participate, you always run the risk of underperformance merely on account of being underexposed or having limited participation into the entire uptick that you could have easily participated into if you did not allocate that portion to cash.
That's very helpful because, usually what everyone looks at, as we've been pointing out, it's just where funds are invested and not when it is kept in that cash basis. So, is there a minimum amount that every mutual fund keeps as cash on an average always, considering steady market levels? Is that also something that investors should look at, or it is ad hoc, depends on the funds and the market conditions?
So mostly it depends on the market conditions and the type of fund and the universe that it is operating in. For instance, if you look at ETFs and index funds, where there is no real need to hold on to a lot of cash, because especially not from an opportunistic standpoint, right, or from an performance defending standpoint as well. The cash allocation for more liquid ETFs as well as index funds would be in the range of, let's say, 0.2 to 0.4 percentage types. as we speak. However, if you look at certain more actively managed funds, probably those who operate in under the thematic category, it could be much higher, probably in the range of 7 to 8%. As we speak right now, so that offers a significant headroom to tactically deploy as well as retract cash from the markets at the same time while maintaining enough buffers for redemption. So these two are key examples of how cash portion is not really steady across the board. It really depends on the kind of fund and the context. Like I said earlier as well, the context is really important. The timing of the context is really important.
We take that point. We'll discuss about whether cash components are different things for debt and equity funds, but you've very helpfully given us or provided us a table as well. So let's try and understand that. What are the cash levels that different AMCs have at the current levels? And, should investors worry when the cash levels are higher? Is that a sign that maybe in AMCs are finding valuations to be higher, or it's the time to redeem some of the money?
So, cash could indeed be one of the lead indicators. In a world where most decisions are made basis hindsight, I feel cash allocation is one of the very few lead indicators that can actually help make a very good decision in terms of understanding how is the fund viewing the market and how does the fund wish to play the market. First thing right off the bat, I'd like to make it very clear that a higher cash allocation does not always indicate a case for caution. It is not necessary that if an asset management company is sitting on higher cash levels, it means that it is not comfortable with the valuations out there. It is also possible that it is expecting certain more opportunities to come up in the distinct and very near future. That's one reason they could be waiting out. Two, it could be a part of an overall deployment strategy where, a fund house would like to participate in select opportunities at, different intervals. And so it would need cash to continuously deploy, right? So that's another reason. Another third reason why they could be holding on to cash is to, apart from, of course, holding cash for redemptions, another important reason that why AMCs could be holding on to slightly higher amount of cash is if they wish to participate in one-off events also. Like for instance, we do know that mutual funds do participate in several IPOs, especially in the anchor round. So if there's limited visibility of further inflows, or they would like to participate to a larger extent, they could hold off on some cash and then deploy it on that for that very particular one-off event or one-off opportunity that comes across, right? So these are a few reasons why an AMC could do it. And at an AMC level, if you look at it, the cash levels are very different for different kinds of AMCs. Okay, and it is different majorly due to a combination of three things. One, what's the kind of cash management policy they have to manage redemptions and fund flows. Two, what is their view on the markets and how are they reflecting it via cash as an active call, active allocation? And three, what is the portfolio construct? So if a mutual fund has if an MF house has many index funds and ETFs, the aggregate or the average cash holding levels could be really low. On the other hand, if the fund house has many actively managed funds operating in very narrow universes, having many thematic funds, it is quite characteristic that there could be patches where the levels are going to be much higher. So, for instance, there are a few fund houses where the levels of cash holding has gone up in double digits, almost above 12 and a half odd percent. It would include the likes of PPFS mutual fund. It would include Quant mutual fund. It could include Shriram mutual fund, Quantum mutual fund. Now, for each of these funds, right, with a cash allocation of, let's say, at an aggregate level, beyond 12 and a half or percentage of the total assets, equity assets specifically, it may, be attributable to the kind of funds that they have, as well as their current view on the markets. Most of these AMCs have been really vocal about their view on the markets and how they may not be very comfortable participating at current levels for some of their funds, right? Now, one thing that's very important to understand is, even if for instance, let's say a fund house has a small cap fund, but the AUM of that small cap fund is a large proportion of their total asset base, and they are not comfortable to deploy in the small cap universe at this levels, the overall aggregate cash holdings could seem slightly higher versus relative peers, right? So, this is one example of how nuanced, interpreting this entire cash allocation thing could be. And most of these details are public domain, right, and very easily available. It does make sense for, each one of us as an investor to not just look at the cash allocation, but try and interpret the reason and the context behind such allocations.
Okay, all right. That's a very helpful explanation, because sometimes there's fear, right? When the cash levels go up, that's the usual question. Are you keeping a lot of cash currently, considering the market levels again at a record high? So that's the question a lot of AMCs have to answer as well. Nirav, we had a lot more questions, but we are completely out of time today. But thank you so much for joining us today and explaining this important aspect of mutual fund investing to our viewers. With that, we'll take your leave on this edition of Mutual Fund Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.